Good afternoon, ladies and gentlemen, and welcome. I'm Chris Andrews, Chief Investment Officer here at Trobe Financial, and we're again pleased to welcome a large number of people from across Australia for our quarterly investor call briefing for the third quarter of the 2015 financial year. So thank you very much for your attendance. Our agenda today is pretty straightforward. We intend to cover the following topics. First, we'll look at domestic and international macroeconomic issues and their impact on investment performance. We'll focus in particular on key economic drivers and key economic indicators. This section will incorporate our much discussed Headwinds and Tailwinds report. Secondly, we'll give an update on the La Trobe Financial Group. And thirdly, we'll talk about how our retail investment fund in particular has performed for investors. Now you should be able to see on your screen where you can type in your questions. Now with the numbers we've got attending today, we may not be able to get through all of the questions during this half hour. We'll answer questions on a first come, first served basis. If there are any questions we can't get to for time reasons, then of course we'll follow up with you personally after the teleconference. Now I should note here, of course, as usual, that I can't comment in this forum on individual assets or individual investments. But of course our investor sales team is, as always, standing by, ready to assist you on any of these matters at any time on 1800 818 818. Now, we've got plenty to get through, obviously. We appreciate that you're all on very tight schedules, so we'll keep this presentation to half an hour maximum. Okay, so with that said, let's move into our Headwinds and Tailwinds report as we move into 2015. And just as a nutshell summary, we can only repeat our previous observation that while the Australian economy continues to face challenges, things are perhaps not as overwhelmingly negative as some of the commentary that we're seeing in the media would suggest. So let's explore that a little. Our headwinds this quarter are focused both on objective macroeconomic factors and their implications for key popular investment strategies. And whilst they may outweigh the tailwinds in number, I'd point out that the tailwinds are real and substantial. So the picture is not all doom and gloom, and that's really the message that we'd like to leave you with today, whilst at the same time acknowledging the challenges that the Australian economy is facing. So we first turn to our headwinds, and our first and most pressing headwind, of course, as we've discussed in the last couple of these conferences, it continues to be sluggish domestic growth. Our December quarter GDP growth rate, the last available print, was 2.5%, which is broadly in line with expectations, but down on the previous quarter. In fact, as the graph on screen shows, the trend over the last few years has continued to be downwards. Now, there's no doubt that low growth is generally a negative thing. Obviously, low growth means lower economic activity, means more small businesses struggling to make ends meet, means fewer businesses looking to expand and put on new employees. It also puts pressure on government taxation receipts, which has obviously been a subject of a lot of discussion recently, and that in turn puts pressure on schools, hospitals, roads, railways, etc., etc., etc. On the other hand, the severity of our current situation shouldn't be exaggerated. On screen you can see quarterly annualised growth since 1990, so a 25-year plus history there. You can see average growth over the last 25 years sitting at around 3.1% or 3.3% excluding the recession in the early 1990s, which is obviously a bit of an outlier if you look at the graph there. Now we are below that rate, but not by so much that at first glance one would be unduly alarmed. What's perhaps the concerning aspect of our growth rate at the moment is the way that this below trend growth is persisting. Now, if we exclude the 4 quarters from September 2011 to September 2012, growth has been below trend for almost 7 years. Now, whilst a healthy economy can easily deal with quarter-to-quarter fluctuations in growth, such persistent softness is a serious concern, and it's reflective of an economy that simply cannot generate substantial momentum. So that's a real challenge for the Australian economy. What's more, when we look overseas, we see a similar pattern of slowing growth, including for our major trading partners. Now again, growth in a percentage rate doesn't necessarily correspond, as we've discussed in previous investment calls, with absolute dollar growth, which, for example, take the Chinese economy, as it grows substantially year on year, even though the rate of growth is slowing, still the demand for goods and services from economies such as Australia's continues to be strong. But the slowing growth rate does have an impact on our own growth rate because it reflects ultimately long-term in reduced demand for our exports. Suddenly our miners, our manufacturers, tourism operators, farmers and so on are receiving less demand for their services. So that compounds our own situation. Should this slow growth rate continue, we can expect to see the employment rate creep slowly upwards. Now, getting a good read on unemployment is obviously difficult at this time with monthly fluctuations, with the ABS doing a review of, in fact, of their labour data. Nevertheless, what we can see looking at the longer term trend is that unemployment has moved from being stable, which was probably in this low growth environment almost a tailwind for the economy, to this quarter starting to show what I think are real signs of an upward trend. So we put unemployment down now as a headwind for investors and for the Australian economy. Stress again, don't be misled by month-to-month movements. This data is notoriously volatile and it is being reviewed by the ABS. But looking at the trend, another quarter's data, we're seeing a concerning picture, I guess you would say, about the underlying trend in unemployment. So while growth remains slow, unemployment is going to continue to creep upwards. For the economy as a whole, low interest rates are generally a tailwind, and we'll explore that aspect of low interest rates in a moment. But for investors, low rates are very much a mixed bag. Now, investors in deposit products are now facing negative real returns. That is to say, as the graph on screen shows, if you are currently holding cash in a bank account, you are probably getting poorer in real terms. That is, when inflation is taken into account. In fact, these negative real returns are not that unusual. Now, I've put another graph on screen. As you can see, for about half of the 21st century so far, real returns on cash have been negative and sometimes substantially negative. The only period of strongly positive real returns was immediately post-GFC, when Australia's banks jacked up interest rates to encourage deposits and reduce their reliance on overseas funding. This period, frankly, I think at this point it's got to be recognised for what it is, an outlier in the modern investment history of Australia, and investors really do need to think about that. Then there's the bond market. Now, many investors remain a bit mystified by the bond market and what goes on there. I'll put a graph on screen from Philo Capital, which tells an extremely interesting story and tells it in context. As you can see, bond yields fell in March in most of the world. And you can see that in that little red square down on the right-hand side of the graph. So why is this? First, a bit of history. If you look at the chart, you can see yields rise, especially in Europe during 2010, 2011, 2012, as investors feared that remember the pigs, remember that acronym? So that was Portugal, Italy, Ireland, Greece and Spain, whether the pigs would have to default on their government debt. Now, when you think about it, that makes sense. As investors perceived increased risk of losses on their government bond investments, they demanded a higher return from those investments to compensate for the risk. That's classic investment theory about risk and return in action, of course. Since then, fears of defaults have subsided somewhat, although everyone is still a bit nervous about Greece and its plans. We'll put that to one side. But what's more, with Europe experiencing price deflation, faltering growth, we've now got the European Central Bank starting its own quantitative easing program, purchasing 60 billion euros a month of sovereign bonds, at least for the next 19 months. All of this works to drive down yields on bonds. Now, a number of European countries have short, medium and even long-term government bonds offering investors negative yields. It's probably not so surprising that you have countries like Germany, Switzerland, Denmark in that category, but even some of the former members of the Pigs Club. So we've got Ireland and Portugal in that situation, which is quite extraordinary. When you think about what this means, either European investors are expecting price deflation, or they've just got no plan B for their money. They don't know where else to put it. They would rather loss-making bonds instead of investing overseas or alternative asset classes, even just hiding it in their mattresses, for Pete's sake. So for governments, obviously there's an upside, with the UK government recently issuing 53-year bonds, extraordinarily long-dated bonds at an incredibly low 2.62% yield. That sort of interest rate on borrowing is worth thinking about when we as Australians reflect on our own need for infrastructure investment and how we may finance that. So that's the bond market. The next headwind focuses squarely on the risks of one of the most common investment strategies of recent times. And since 2010, 2011, many investors have been investing in equities for the dividend yield. That's a long-hallowed investment strategy, and there's little doubt it's been successful over this period. There have been some very strong dividend yields on offer, often boosted significantly by franking credits. It is important, though, to remember investors need to hold on to the fundamental characteristics of investing in equities. As we know, we all know this, fixed interest investments typically do not deliver returns as high as equity investments, but in exchange, investors get greater certainty of return. Equity investments expose investors to capital risk. Now, just a reminder, something that's been, I'm sure, burnt into all of our memory banks, the S&P ASX 200 dropped nearly 50% during the GFC. 7 years later, it's still down by about 50% on its pre-GFC highs. It keeps tickling 6,000, even before inflation is taken into account. Now, for investors who needed to sell down portfolios for living expenses over that period, that's a very significant capital hit. Importantly, while fixed interest yields derive from legal obligations, so the borrower, if you like, has got a legal obligation to make repayments, a dividend is by its very nature discretionary. It might look solid right now, but if circumstances for the company in question change, the dividend is the first thing to be dropped. Underlying capital and income risk is the fundamental equity risk of volatility. Equity markets and individual equities are prone to volatility, and as we've already seen, this volatility can result in multi-year or even multi-decade long periods of underperformance. So it's a potential headwind for the Australian economy that so many investors are at least potentially not fully turning their minds to this risk. If we take one of the darlings of the equity for income strategy over the last few years, we'd look at Telstra, and understandably so. But if you take an objective long-term observation of the Telstra share price, you see a very mixed bag for its investors. Now, this is not to deny the validity of equity-based investment strategies. It's simply to remind investors that we really need to take into account all the risks involved in any investment strategy, including this one, even and perhaps especially if it's the, if you like, the darling strategy of the day. So now we turn to tailwinds, those factors that are pushing the economy or investors' portfolios forward. And the first tailwind is inflation, or shall we say more precisely, the lack of inflation. Now, you're probably aware that the RBA, the Australian Reserve Bank, has a mandate to use monetary policy to keep inflation between 2 and 3%. It's been well within this range for some time and is currently at the lower end of this range. That, of course, has given the RBA the scope to hand on massive interest rate reductions, which is why the OCR, the official cash rate, now sits at record low levels. The purpose of low interest rates, of course, is twofold. Firstly, to stimulate the economy by reducing loan repayments and leave more money in the hands of the borrowers, encouraging more borrowing, encouraging more investment. And secondly, to reduce the exchange rate, and this has become particularly of note recently, by making Australian investments relatively less attractive when compared to international alternatives, which are, it is fair to say, still at lower rates, but on a relative basis to make Australian investments less attractive. And as they become less attractive, there's less demand for the Australian dollar to buy into them, and the laws of supply and demand kick in, reducing the exchange rate, in turn making our exports more attractive to international purchasers. Now, there is controversy as to whether and I guess to what extent the RBA should be targeting the exchange rate, but statements from Governor Glenn Stevens make it clear the exchange rate is one of the factors that they are considering as they make their decisions on monetary policy. There's no doubt that these low rates are wonderful for borrowers. So the 25-year chart on screen shows how low housing lending rates are compared to historical averages. If I look back to my own undergraduate studies in economics in the early 1990s, few would have predicted this sort of outcome. The consequences for housing prices have been predictable. When finance is at historical lows, the rational investor takes advantage of that to purchase real assets like property. So while it's true that Australian houses, particularly in Sydney and Melbourne, as the chart shows, are expensive compared with other countries at this point, prices appear to be driven by low interest rates, high demand and significant and ongoing undersupply problems in the market. Now, that doesn't mean prices can't contract. You'll never hear anyone at La Trobe Financial saying that. But a massive and sudden correction, the talk of bubble that we keep hearing in the press, keeps sticking its head up, it just does not look plausible at this stage. This, I guess, is especially true when we look at the state of household finances, which we have down as our third tailwind. Although debt levels remain at historical high levels, the cost of servicing that debt has actually dropped significantly since the early 2000s because, of course, of the low interest rates. What's more, household saving rates remain at the highest levels, as you can see, since the mid-1980s. Other stats like mortgage aheads, arrears and so on all paint a picture of a nation that is highly indebted, that's true, but it is also squirreling away funds for the hard times. So it's a very interesting mix, and I have to say when you look at the household balance sheet, probably a mix that can't last forever. Either indebtedness levels will begin to subside or the cost of servicing will go up. But the persistent fears of some commentators about the state of household finances, they're just not currently reflected in economic data. The same broadly goes for Australia's economic situation. We've got risks and we do need to respond to them. We've spoken about the situation with government and the political challenges that we have at the moment with balancing budget, with arranging and aligning infrastructure investment. We've got risks, we need to respond to them, but we should be wary of overemphasising the negatives, which of course sometimes become self-fulfilling prophecies. So that's the Headwinds and Tailwinds report. We now turn our attention to the La Trobe Financial Group, and the March quarter was a very pleasing one for the group and our investors. We received an unprecedented third consecutive award for excellence in mortgage fund performance at the prestigious International Investment Review Awards in Hong Kong, so that's an award we're very proud of. We retained our independent ratings for our retail fund. We also entered into a very substantial sponsorship agreement with the Collingwood Football Club, which continues to be one of Australia's leading sporting brands. So to view our awards and ratings and to keep up to date with all the news at La Trobe Financial, please visit our website at latrobefinancial.com.au. And the work, obviously, that sits behind what we've been delivering in the market continues to be impressive. We had $675 million worth of originations in the March quarter, which is particularly pleasing, given that this included the traditionally slower month of January. We're pleased to continue to have one of the broadest product offerings in the market across the residential and commercial sectors. We've had a huge variety of meetings with our various clients since our last teleconference. We attended the SMSF Association conference in Melbourne, which was an outstanding opportunity for our team to meet with many of our advisor and investor clients. Randall Williams, who you might recall from our last investor call teleconference and his presentation on La Trobe Financial's international strategy, Randall Williams delivered a symposium series in China with the subject of investing in Australia. And we had a number of very impressive collaborating partners on this venture, including the Victorian State Government, King & Wood Mallesons and Ernst & Young. Always a real pleasure to speak with overseas investors who are interested in investing in Australia, and the symposium was warmly received in Beijing and Shanghai. We also presented to a very friendly and, if I can say, insightful group of investors in Noosa in Queensland through the auspices of our authorised representative Andrew Mountford. We also have one of our senior manager client partnerships currently presenting internationally to a group of financial advisors. Meanwhile, we were pleased to present a teleconference to the brokers of one of our important broking partner on our parent-to-child product, which, as you'll recall, is a product designed to assist parents and deliver safe and professional management for parents who wish to assist their children with the purchase of a home. And of course, our activities are not going to stop there. We've got a number of events upcoming, and I've put a couple of them on the screen. In May, we'll be attending the MFAA National Conference to meet with our broker clients and discuss industry developments. In the same month, we'll also be part of the Rainmaker Advisor Big Day Out Roadshow, touring regional Victoria and also Tasmania. So very busy times in terms of our discussions with our clients. At a financial level, all key metrics continue to build throughout the quarter. We're always very focused on steady, measurable growth and are pleased to be sitting above the $2 billion threshold in terms of funds under management, with continued retail and institutional growth expected. This should continue to increase steadily in coming quarters. A net asset position continues to strengthen too, with the group currently sitting on $86 million worth of net assets. So that's a quick summary of La Trobe Financial and how the group is sitting at the present. I'd like now to introduce our special guest for today, who is La Trobe Financial's Vice President and Chief Wealth Management Officer, Martin Barry. Martin, welcome.
Thank you, Chris, and great to be here.
Martin, perhaps you could start with a little about your background, because it is an interesting one.
Sure. I'm originally from the UK, Chris, and I graduated in physics from Imperial College in London. From there, I trained as an actuary with PricewaterhouseCoopers and then moved into banking, joining the Royal Bank of Scotland. My focus at RBS was on financing mortgages for clients like La Trobe Financial. Actually, that's how I got to know La Trobe Financial, as I had an overseas posting to Australia.
Great stuff, Martin. And what's your role at La Trobe Financial? Perhaps explain that for our listeners.
Sure, happy to, Chris. I head up the Sydney office, where we have a full suite of services from the lending to the investment side. We have been quietly growing this office for the last year or so and now have 12 people on the ground, with plans to get towards 20 or so in the near future. We really see our expansion in New South Wales as an opportunity to service our clients more locally and complement the head office team. So it's a really exciting time within the business here.
And what functions do you have in Sydney, Martin?
Well, Chris, we have business development managers, loan underwriters, and investor liaison staff. So it's really across the entire spectrum. We plan to add headcount to all those functions. So as I say, it's a great, exciting time in the Sydney office.
Okay. So Martin, tell me a bit about what you do from day to day, and perhaps also why you joined La Trobe Financial from the banking side of the industry.
Chris, my focus is on managing monies that we borrow from the institutional markets and also coordinating our residential mortgage-backed securities, RMBS, activities. This is what I did for my clients in my banking days, and now I do this in-house for La Trobe Financial. We plan to do lots more in this space, and this is one of the reasons I joined La Trobe Financial. More broadly, I joined La Trobe Financial because I'm passionate about financial services, and of course I wanted to work with the best team.
Now you raise a number of interesting points there. We've touched on RMBS before. Perhaps Martin, you could give us a quick refresher?
Yes, certainly, Chris. RMBS, or residential mortgage-backed securities, are investment securities where the underlying assets are pools of, well, residential mortgages. So very much like your fund, Chris, except RMBS pools are closed. RMBS has been around for a long time, but is not widely understood by investors, as it has mainly been focused on the top end of town investors. But we are starting to see more press around this topic now. The RMBS investments tend to be of medium-term duration and floating rate, meaning the interest payable varies with movements in the underlying base rate. The size of the market is some $40 billion per annum, but as I say, it has mainly been focused on large institutional investors and banks. What we are seeing now is, as investors learn more about fixed income investing, there is more interest and inquiry in RMBS. Indeed, we are turning our minds here at La Trobe Financial to how we may be able to offer investors access to RMBS in the future.
Okay, so what are the risks in RMBS then?
Much like any mortgage investment, Chris, it's the credit risk on the underlying borrowers, house price risk, diversification, and liquidity. RMBS is no different in that respect. Where it can be different is investors can decide to take a particular risk profile and obtain differing returns. For La Trobe Financial RMBS, we have diversified pools and, of course, high-quality underlying loans, all underwritten by our expert in-house credit team.
Thanks, Mark. Now, one thing I wanted to pick up on, you mentioned your passion for financial services and how that brought you to from La Trobe Financial. Where does that come from?
Well, there's a good tale here, Chris. I'm fascinated by the industry, and I think it started when I was delivering newspapers back in the UK as a child, and I would read a little bit of the Financial Times before popping it through the letterbox. I'm really intrigued by the products, the interaction of banks and others like us at La Trobe Financial in the broader economy, and how that all fits together.
From newspaper boy to RMBS guru. But it's also been an international journey for you, hasn't it? You're from the UK, you've lived in Japan, worked across Asia, and you're now living in Sydney, and I think married to an Australian too. So how does La Trobe Financial stack up with what you've seen in these other great financial centres?
Good question, Chris. I have reviewed many organisations similar to La Trobe Financial, and I would say the following things. Firstly, La Trobe Financial has a long 63-year history surviving many different economic periods. So there's a longevity there that is not present necessarily in others. Secondly, in other parts of the world, some businesses borrow too much and don't have the financial strength of, say, La Trobe Financial. Thirdly, in terms of credit underwriting process and compliance, La Trobe Financial has an industry-leading team with many continuous years of service. So in my view, La Trobe Financial stacks up very well in my experience. I would just say, to add to that, in this industry, many organizations have similar products, and what separates them is culture and approach to clients and staff. I know at La Trobe Financial we work very hard on this, and this is reflected in the business growth and also our staff retention.
Okay, that's excellent. Look, just to wrap up, Martin, noting the time, what's on your agenda for the next few months?
Chris, we plan to issue a RMBS in May of this year, so that's keeping me quite busy at the moment. Beyond that, I'm working on some new product initiatives in the non-mortgage space, and we'll have some news in that regard later this year.
Excellent. Well, look, Martin, many thanks for your time and good luck with those plans.
Thanks very much, Chris.
That was Martin Barry, head of the Sydney office for La Trobe Financial. And if we now move on to the rest of the presentation, we'll deal with our fund performance update, and I will go through this section quickly, noting that we are starting to run short on time. The March quarter average returns of the cash and mortgages and pooled mortgages option, well, they were very healthy returns over benchmark. For the cash and mortgages option, it was 1.53% over the official cash rate. And for the pooled mortgages option, it was 1.59% over the old UBS Bank Bill Index, which is now, of course, the Bloomberg Ausbond Bank Bill Index, plus 1.5. The longer-term performance of both options continues to be very strong, certainly reflecting the strength of our investment philosophy in what appears to be an extended period of very low market interest rates. Graphically, we can see the pooled mortgages options return against the various 12-month term deposit indices. Extremely powerful performance for investors, although we note, as we always do, that the pooled mortgages option and cash and mortgages option, for that matter, they're not bank deposits and are not subject to the federal government deposit guarantee. Also note that past performance is, of course, not a guarantee of future performance. In the same spirit, have on screen the cash and mortgages options return in comparison to key online account indices, and you can see very pleasing performance for our investors there. To put the pooled mortgages options return in context, we return, as we always do, to the comparative annualised returns since inception. Other asset classes, including Aussie equities, property securities, global equities, Aussie fixed interest and cash. The pooled mortgages option is the orange line running straight through the middle of your screen. We frequently point out, while every investment type has its own merits, this picture encapsulates what we are trying to deliver for our investors, which is regular, low volatility income uncorrelated to other key markets. When considered on an accumulation basis, that sort of performance produces a very strong absolute return. Obviously, the pooled mortgages option was not designed to outperform equities over the long term, but when you deliver strong monthly returns so consistently, the numbers do begin to add up, and that's what this graph shows. So we've got some consistent themes emerging. Economic growth, or lack thereof, of course, is a key threat to investors' portfolios, but we've got to avoid the temptation to be stranded, I guess, in negativity. Opportunities continue to abound, and at La Trobe Financial, we are still focused on maximising these opportunities and growing our business. We aim to provide industry-leading returns for our investors, certainly on a risk-adjusted basis, particularly in these difficult times. So on that note, I think I've really only got time for one question, so I will address a question from, allow me just to turn to the section. Okay, so we've got a question on how our arrears are tracking. Yes, look, I mentioned earlier that arrears broadly across the economy are very stable, and certainly that's the experience we're having too. If we look at our flagship pooled mortgages option, we see typically arrears, 30-day plus arrears, sitting in the, broadly speaking, in the 3 to 4% range, very comfortably in that range, and have been for an extended period of time. Obviously, there's always in arrears figures, there's month-to-month volatility, but the underlying trend is very solid, very stable. And we're of course committed always to being very transparent about these matters. So we produce all our arrears figures for our fund on our website at latrobefinancial.com.au. They're produced on a monthly basis, so I'd invite you and ask that anyone with any interest in that could always feel free to download those statistics from our website. For our other questions, we have a couple of other questions there, so to Liz and to Andrew, we'll follow up those with you separately. But from us now, I will take leave. Thank you very much for your time, ladies and gentlemen. I wish you all the very best with the rest of your day, and look forward to catching up again for our next Investor Teleconference. Thank you very much, and goodbye.